Automation, robo-advisors, AI investing. A new approach to investing has been making a name for itself for a number of years now, marketing its convenience, simplicity, and lower fees to the mass market investor. The wealth management industry has been stuck in the past, locked in tradition, and is ripe for change to suit the modern and fast-paced world that we live in. Welcome to another episode of Money Matters. It's not just wealth management. Banking is seeing a change too. New players in the market with their virtual banking licenses, pitching themselves as anti-banking organizations, claiming to offer banking without the banks. Consumers want banking without the long-standing frustrations of dealing with a traditional bank, particularly for the new wave of consumer, the millennials, who want everything in the palm of their hands without the hassle of dealing with a person. They want speed and convenience. Robo-advisors offer a similar proposition. Investors can open an account on their smartphone, be guided via a step-by-step process, the machine spits out an answer, you transfer your money in, and boom, the game begins. A Bloomberg report highlights that a rush of new clients, mainly from the younger demographic, are signing up for robo-advisory services. The subsector has shown strong growth, albeit from a low starting place. A report from analytics firm Hearts and Wallets in September shows that only 8% of US households are using robo-advisors, showing great potential for growth. However, there are concerns that the robo-advisory services are so commoditized and margins are so tight that it may be difficult or unattractive for established players to enter this market. There are also signs that the classic B2C robo-advisory model may be stalling. There just may be too many players in this market, each jostling to be the go-to brand for investors to park their cash. The robo-advisory firms are now incorporating a B2B model, offering their clients a second option of accessing a human wealth advisor, building a more complete offering as well as building multiple income streams. They are also attempting to work with more established client pools, such as those belonging to retail banks or insurance agencies, complementing their existing products and seeking co-alignment of services. Robo-advisory firms are now taking a far more enterprise-focused approach to asset acquisition. However, this pandemic has shown that many investors still require human touch, using traditional financial planning skills to help them understand the parameters of their investment decisions and to build a portfolio that matches their long-term life goals. Many investors still need encouragement to save their disposable income and to invest their excess cash reserves to secure them a brighter future. Investment in many ways is still a push product. Financial education is basic at best, and the general public still do not fully realize the full benefits of investing in the financial markets. I've often stated that apathy is the biggest challenge facing investors. Apathy perhaps is less of a concern for the high net worth community that I serve, as they don't often have the same worries about their financial future. But for the majority of people, personal advice, financial education, tailored recommendations, and ongoing management is not just crucial to investment success, but to give them at least a basic level of retirement. During this pandemic, where market volatility has been particularly high, the biggest risk to investment success are the mistakes made by the investor. Left to their own devices, investors are their own worst enemy, often making emotional investment decisions that lead to poor returns, or worse, making significant losses. Wealth managers, or at least those who do their job properly, help investors to remain steadfast, understand the markets better, and help them to achieve outcomes in line with their financial objectives. Robo-advisors have their place in the private wealth management space, as they're often seen as less intimidating, more accessible, simpler, and more convenient. And if they entice more people to invest into the financial markets, then this is only a good thing. On a side note, sustainable investing and ESG will help to entice a new generation of investors to get involved. Millennials have shown a keen interest in sustainability, and where ESG may have been perceived as a marketing tool in the past, it is a genuine strategy to manage risk in the long term. JS Wealth will be launching its own DIY proposition, leveraging on the iFast platform to allow more hands-on investors to play in the financial markets. Watch this space. DIY investing is a genuine alternative to seeking help from a wealth advisor. See it as cooking at home as opposed to dining at a restaurant. The most tangible benefit is that of cost reduction. These are two non-competing sectors in the private wealth space. It's just a matter of personal preference. You can see my video on DIY investing versus seeking help from a wealth professional by clicking on the link. Thank you for joining me in this episode. Ask me a question about your portfolio in the comments below and let me know what other videos you would like to see in future episodes. Smash the like button, subscribe, and I'll see you in the next episode of Money Matters.